This quote by Peter Lynch is a good place for us to start our video. Our goal is not to predict, but to use historical and current evidence to determine probable outcomes. One of the best ways to determine probable outcomes is to look at the longer-term time frames to identify the primary trend. We can also look at outcomes from similar periods in the past and current evidence to see if there are patterns of human behavior that repeat themselves. When investors can't see the primary trend, they are often knocked out by shorter-term countertrends in the market. Since our goal as trend followers is to profit from the primary trend as long as possible, we have to be able to distinguish between countertrends to ignore and tops in the market. Longer-term time frames can tell us about the primary trend. This is a chart of the S&P going back to 1927. We see that long periods of sideways movement are followed by long periods of gain in the market. We just emerged from a 17-year period of sideways consolidation in 2013, and the primary trend is up, even with the current correction. Looking at the intermediate time frame shows the 2015 to 2016 correction, followed by a 34.8% gain. Now we have the 2018 correction. The market often has to digest its gains through time and price. Looking at the longer-term time frame shows that the primary trend is up. Now let's look at the evidence on the shorter-term time frame. This is a daily chart of the S&P. In a bullish trend, we want to see higher highs and higher lows. The picture here is mixed. We see lower highs, but we also see higher lows. The length of the candlesticks representing price change and volume are additional pieces of evidence. To continue in a bullish trend, we want to start seeing longer white candles. Most trading platforms show these as green, and greater volume on green days. We can also look at the strength of the downward moves. Long candles covering large price drops show a strong downward move. Notice that the pushes to the downside have grown weaker and weaker. This could change and will change accordingly, but it hasn't yet. One of the patterns you commonly see when neither the bullish nor the bearish camp is in control is a symmetrical triangle. The good news is that this is usually a continuation pattern of the current trend, and the primary trend is bullish. Price can only move out of the range by breaking up or down, and having a plan for either scenario is key. What can we learn from other indexes and ratios? The VIX is the market's fear gauge. The more investors are concerned about the stock market, the more the price of the VIX goes up. Notice that the VIX has been going down since the start of the correction. A price of 15, as a rule of thumb, has been an average price level for the VIX, and last year was abnormally low. Combined, the red and green line form a pattern that we refer to as a descending triangle, shown in gold. Price usually breaks to the downside of descending triangles. The VIX going down bodes well for better stock market outcomes. This chart shows the price ratio of high-yield corporate bonds to 7 to 10-year U.S. Treasuries. If the ratio is up, more market participants want to be in riskier high-yield corporate bonds than safe U.S. Treasury bonds. As you can see, investors are in risk-on mode versus risk-off. This evidence also tells us that stock market outcomes might be better than expected. This chart shows the price ratio of consumer discretionary items to consumer staples. Typically, in times of market turmoil, investors flee to stocks of consumer staples companies who make basic household items that consumers will need to buy whether we're in a recession or not. Items like toothpaste, soap, cereal, and soup. When the economy is good, consumers spend on discretionary items and services from companies like Amazon, Netflix, and Nike. As you can see, investors are betting on a good economy and higher consumer spending, and the ratio is up. The global financial crisis of 2008 is still fresh in everyone's mind. Since this was a market top, and we want to distinguish between corrections or countertrends versus a market top, Let's see if there are characteristics that we can identify and watch for in the present day. Here again we see a weaker bullish trend. Note the compression in the moving averages. This is caused by volatility in price. Before the moving average crossover, we get deeper and deeper incursions of price into the moving averages. These represent periods of distribution from early buyers to buyers who are coming late into the trend. Finally, price breaks through, and once the trend rolled over, there was a 57% loss from peak to trough. Now we come to the present day 2018 correction. The moving averages have strong spreads, and price has not closed below the moving averages. The closing price is most important and is part of the body of the candle, not the thin lower wick. Note that price has been trading in a range, bounded by a high and a low. We'll be watching this for any changes. So let's compare 2018 to 2008. We see that 2008 featured a weaker bullish trend with more volatile price and compression of the moving averages, leading up to a trend rollover. The 2018 correction at present shows a very strong bullish trend, and we haven't had any closes below the moving averages. Here are some of our research on corrections going back to 1936. There were 30 corrections in this period, lasting an average of 122 days. There were 17 corrections where the weekly moving averages remained positive throughout the correction, and these corrections lasted an average of 68 days. You can view the full table by following us on Twitter or Googling our Twitter handle @CaliberCap, and you can view our post from April the 25th. Given that the moving averages have remained positive throughout this pattern thus far, this does not look like a trend rolling over into a bear market. We often look for continuity of direction across time frames, for conviction about direction. As of today, April 26th, the picture is mixed, but there are key levels that we want to close above. The first milestone would be reversing the current downward direction by closing and holding above the monthly March close. The second milestone on the way to resuming the bullish trend would be a break above the downward red trend line that represents a border of price discovery, bounded by gaps in price. Let's finish with our game plan, looking at the symmetrical triangle. What we would like to see is clearing this area of resistance at 2650. As of this morning on April the 26th, it looks like we may. If we can, there's a higher probability of breaking the upside of the triangle and going on to making higher highs. Our model scores improved yesterday, and we are comfortably maintaining all of our long positions. Our model scores would change if the evidence changes. We have a list of defensive assets that we would move into incrementally should we break below the lower boundary of the triangle for more than a few days. Another very decisive level to the downside would be a sustained break below the February low. At this time, the current movement is to the upside, but we're well prepared for either outcome. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.